Lesson 28. Grid trading and high-frequency approaches. So far in this course, we've focused mostly on trend-following strategies, where you buy when something is going up and ride the move for hours or days. That is a fine way to trade, and for most people it is the right place to start. But there is a kind of market where trend following is genuinely painful, and that is when price just bounces back and forth in a range without ever committing to a direction. In that environment, your trend signals fire late, the move reverses before you exit, and you spend the week getting chopped to pieces. Today's lesson is about two families of strategies that exist precisely for that kind of market. And for the opposite extreme, where price is moving so fast that you want to be in and out in minutes. We're talking about grid trading and high-frequency approaches. I want to be honest with you up front. These are more advanced. They carry more risk, and they're easier to get wrong than the simple strategies we've built so far. So treat this as exposure to ideas, not as a license to start trading them live next week. How grid trading works. Let me explain grid trading with a picture in your head. Imagine a coin that has been bouncing between roughly 29,000 and 32,000 for a few weeks. There is no real trend, just a back and forth. A grid strategy doesn't try to guess which way it is going to break out. Instead, it picks a center price somewhere in the middle, say 30,500, and then lays out a ladder of price levels above and below it. Every 1% below center becomes a buy level, and every 1% above center becomes a sell level. So price drops to 30,000, which is one grid below center, and the bot buys. It keeps dropping to 29,500, two grids below, and the bot buys again. Now price reverses, climbs back through 30,000, hits 31,000. Price falls back to 30,000. The bot buys again. Cycle repeats. Every time price travels one grid in your favor, you exit with a small profit, and every time it travels one grid away, you add to the position. The appeal is obvious. You are not predicting anything. You just need the market to move, and to stay roughly within the range you defined. In a market that oscillates like that, the grid racks up a lot of small wins, and the win rate is usually high, somewhere in the 60 to 70% range. That feels great. Psychologically, there is something deeply satisfying about a strategy that wins frequently, even when each individual win is small. Where grid trading gets crushed, now here is where I have to be the boring adult in the room. The market that prints money for a grid is the ranging market. The market that destroys a grid is the trending market, and it destroys it in both directions. Imagine a coin that just keeps climbing. Every time price ticks up, the grid sells, taking a small profit. But it keeps climbing, and the bot never gets to buy back in lower, because there is no lower. So you end up with a series of tiny profits and a coin that doubled without you holding any of it. You left a huge move on the table. That is called selling too early, and it is a slow kind of pain. The other direction is worse. Price drops through grid 1, you buy. Drops through grid 2, you buy more. Keeps dropping. Grid 3, 4, 5. Your capital is committed, your average entry is sinking, and price is still falling. The classic phrase for this is catching a falling knife, and it is how grid traders blow up. If the market doesn't come back inside your range, you are left holding a heavy bag of an asset that is down 30 or 40%. So the very first honest rule of grid trading is that you have to be reasonably sure you are in a ranging market. You don't predict where price will go, but you do have to predict what kind of market this is. There are filters that help. One common one is to look at ADX, which is an indicator that measures how strong a trend is. If ADX is below 25 or 30, you are probably in a choppy market, and the grid is relatively safe to run. If ADX is climbing, the trend is strengthening and you want to stand down. That is not a guarantee, but it is a meaningful filter. The plumbing of a grid. Let me talk about the actual knobs. There are 3 of them, and getting them right matters more than the code. The first is grid spacing, meaning how far apart the levels sit. If you set it too tight, like 0.5%, you'll trigger constantly, but each profit is tiny and the fee eats most of it. If you set it too wide, like 5%, you capture more per trade, but you'll get very few trades in a quiet market. For most coins in a normal range, something around 1 to 2% is a reasonable starting point. The second is the number of grids. 5 to 10 is typical. More grids means more potential entries on the downside, which sounds good until you realize each one is real capital you are committing. 10 grids means 10 batches of your money potentially getting deployed in a sustained drop, and you need to have that money sitting ready. Which is why grid trading is capital hungry in a way trend following isn't. The third knob is the center price. The simplest version is to pick a fixed number when you start the bot and leave it. That works fine for a while, but eventually the market drifts and your center is no longer meaningful. So the better approach is to make the center dynamic, computed as a moving average over the last 100 candles or so. As the range shifts over time, the center shifts with it. The grid breathes with the market instead of being bolted to a number you chose 3 weeks ago. A more advanced version of the grid does the same thing with the spacing. Instead of a fixed 1% gap, you compute spacing from ATR, which is a measure of recent volatility. When the market is calm, spacing tightens and you take more trades. When volatility spikes, spacing widens and you don't get whipsawed. I'll be honest, this kind of dynamic adjustment is nicer in theory than it is easy to get right in practice, but the intuition is sound. The fee problem here is the part that catches new grid traders off guard. Grid strategies trade a lot. 10 to 20 trades a day is normal, sometimes more, and every trade pays a fee, both on the way in and on the way out. So let's do the math. If your fee is 0.1% each way, that is 0.2% round trip. If you do 20 trades a day for a month, you've paid roughly 120% of your trading capital in fees, in the sense that fees are 0.2% of each trade's notional, and you are churning the entire position constantly. Even at lower numbers, fees can easily eat half your gross profit. The way to handle this is twofold. First, get your fee rate as low as you can. Use VIP tiers on your exchange. Use the exchange's native token if it discounts fees. That kind of thing. Second, when you backtest, set the fee accurately. Don't lie to yourself and put in 0.05% when you are actually paying 0.15. The whole point of the backtest is to know whether the strategy survives reality. Also make sure the average profit per trade is comfortably larger than the round-trip fee. If your average win is 0.4% and your fees are 0.2% round-trip, you are keeping half of what you theoretically made. That can still work, but it is tighter than it looks. High-frequency trading, and the honest truth about it, the second half of this lesson is about high-frequency trading. And I want to be careful with the language here because the term gets misused. True high-frequency trading, as it exists at professional firms, is a millisecond game. They're collocating servers inside the exchange's data center. They're writing custom networking code. They're measuring latency in microseconds. The whole edge is being a few microseconds faster than the next guy. That is not something you can do with Freqtrade, and frankly, it is not something a retail trader can do at all. If anyone tells you they'll sell you a retail HFT bot that competes with the institutional players, walk away. The math doesn't work. What you can do with Freqtrade, and what people often mean when they say high frequency in a retail context, is medium. High frequency trading, also called scalping. You are holding positions for minutes, not milliseconds. You are aiming for tens of trades a day, not thousands. You are trying to capture very small moves, on the order of 0.5% to 1%, and you are doing it over and over. The structure of a scalping strategy looks like this. You use a 1-minute chart because you need to react fast. You use market orders, not limit orders, because you'd rather get filled immediately than wait for a slightly better price that might never come. You set a very tight take profit, somewhere around 0.5% after a few minutes. You set a tight stop loss, around 1 to 1.5%, and you cap the holding time, say 30 minutes, after which you close the trade no matter what. The idea is to be in and out before the market has time to move against you in a serious way. For entry signals, scalping strategies lean on fast versions of the usual tools. A 5-period and 10-period EMA, where a cross tells you short-term momentum has shifted. A short RSI, maybe period 7, recovering from oversold. Narrow Bollinger Bands to spot when price has stretched away from its mean. And critically, a volume surge filter, because in a thin market your market order will move the price against you, which is called slippage. And slippage is where a lot of small profit strategies quietly die. The honest risks of scalping. Let me lay out the 4 ways scalping tends to lose money because it is important. The first is fee erosion. The same problem as grid trading but worse. If you do 100 trades a day at 0.1% each way, that is 20% of your capital gone to fees in a single day if you are churning the full balance. Even at lower volumes, fees are the dominant cost. You need an average profit per trade that comfortably beats the round-trip fee, or you are working for your exchange, not for yourself. The second is slippage. When you use market orders, you get filled at whatever price the market offers, which is rarely exactly the price you saw. On liquid coins like BTC and ETH in normal conditions, slippage is small. On smaller coins or during volatility spikes, it can be brutal. You thought you were buying at one price, and you actually bought noticeably higher, which means your trade started in the red before the market even moved. This is why scalpers stick to the most liquid pairs and avoid trading during news events. The third is overtrading. Once you set a bot up to scalp, it will find a lot of signals, and a lot of them are noise. A 1-minute chart is full of false moves. If your bot takes 200 trades a day, many of them are going to be losers that collectively outweigh the winners. A common safeguard is to set a daily maximum trade count, say 50, and to raise the entry bar high enough that the bot is picky. Volume filters help here too, because real moves tend to come with volume and fake moves tend not to. The fourth is infrastructure. If your network drops for 30 seconds during a scalping trade, you might miss your stop loss and eat a much bigger loss than you planned. If you hit the exchange's API rate limit, you can't place orders at all. For real scalping, you need a stable server, ideally a VPS close to the exchange, a backup connection, and monitoring that yells at you when something is wrong. Most retail traders don't have this set up properly, which is part of why retail scalping usually underperforms its backtests. How the three strategies compare it helps to put these side by side with trend following, so you can see the trade-offs clearly. Trend following trades maybe 3 to 5 times a day, holds for hours to days, and aims for 2 to 5% per trade. It is patient, it has low technical requirements, and fees barely matter because you trade so rarely. The win rate is modest, around 50 to 60%, but each win is several times each loss. So the math works. Grid trading sits in the middle, 10 to 20 trades a day, holding for hours, aiming for 1 to 2% per trade. Win rate is higher, 60 to 70%, because each small move has decent odds of resolving in your favor. But capital requirements are higher, because you need to hold multiple positions at once, and fee impact is meaningful. Scalping is the extreme, 50 or more trades a day, holding for minutes, aiming for under 1% per trade. Win rate is similar to grid, 55 to 65%, but fee impact is enormous, and the technical requirements are real. Risk level is genuinely high. I want you to notice the pattern. As trading frequency goes up, the strategy gets more sensitive to fees, more sensitive to slippage, more demanding on infrastructure, and more prone to small mistakes, compounding into big losses. There is nothing magical about trading fast. For most people, slow and patient is the harder to break version of profitable. A few honest suggestions if you are going to experiment with these. Here is how I'd suggest approaching it. First, don't start with grid or scalping. Start with trend following. Get a feel for how Freqtrade behaves, how backtests lie to you, how live data surprises you. Once that is boring and familiar, then poke at grid trading, because grid is the gentler of the two. Scalping is the last thing you should try, and only once you've got a real handle on costs and infrastructure. Second, when you backtest grid strategies, deliberately test them on time periods that include strong trends, not just ranging periods. You want to see how badly the strategy gets hurt when the market does the thing it isn't designed for. If the drawdown in a trending month is something you genuinely couldn't stomach, then you don't have a strategy you can run unattended. You have a strategy that only works part-time and you need a regime filter on top of it. Third, do a fee sensitivity test. Take the same strategy and backtest it 3 times with 3 different fee rates, say 0.05%, 0.1% and 0.2%. You'll often find the strategy looks great at the lowest rate and falls apart at the highest. That tells you how dependent your edge is on getting a good fee deal, which is information you want before you commit real money. Fourth, paper trade everything for at least 2 weeks before going live. The thing about both grid and scalping is that they break differently from trend following. You'll see fee surprises, slippage surprises, API rate limits you didn't expect. Better to find those in dry run with fake money than in production. And finally, consider running a portfolio of strategies instead of just one. A common setup is to put most of your capital, say 70%, in a trend-following strategy that is slow and stable, a smaller chunk, 20%, in a grid strategy that you only enable when the market is clearly ranging, and the last 10% as experimental capital for scalping or whatever you are testing. That way, each strategy covers the other's weak spot. Trend following does well when grid gets crushed. Grid grinds out small wins when trend following has nothing to do. And the experimental bucket is small enough that mistakes don't hurt. The honest bottom line, I want to end where I started. These strategies are more complicated, and complication has a cost. Every extra knob you add is something you can misconfigure. Every extra trade you take is a fee you pay. Every extra second of latency you tolerate is slippage you eat. There is a real temptation to think that more sophisticated means more profitable. But in my experience, it usually means more ways to lose money in ways you didn't anticipate. The phrase I keep coming back to is this: simple and effective beats complex and fancy. If you have a trend-following strategy that is making steady money, and you understand it fully, that is a good place to be. Grid and scalping are tools to add when you have a specific reason, like a clearly ranging market that you want to milk, or capital you can afford to risk on a faster approach. They're not upgrades for their own sake. So that is the lesson. Grid trading layers buy and sell orders across a range and profits from oscillation until a trend takes it apart. High frequency, in the retail sense, means scalping for tiny moves on tight timeframes. And it is a game dominated by fees and slippage, rather than by clever signals. Both are worth knowing about, neither is required to be a profitable quant trader, and both deserve serious respect before you put real money behind them. In the next lesson, we'll move on to a different kind of approach entirely, where we start using machine learning to find patterns our hand-coded rules might have missed. I'll see you there.